RSI trendline trading strategy. Using trend lines directly on the RSI indicator itself is a method of using RSI that many people miss. It's similar to how we use trend lines on regular price charts. The RSI trendline strategy is a special strategy that focuses on reversals, and it uses the RSI indicator in a unique and different way. Trend lines are lines that traders draw on charts to connect prices or show the best fit for certain data. These lines help traders understand the possible direction in which an investment's value could go. Trend lines are used to show if the price is moving up, down, or staying the same. Traders draw confirmed trend lines by connecting a low or high point of a cycle with at least two other highest or lowest points on the chart. This creates a line that best fits the data and helps traders see the overall trend. The rules of this system are simple. We just need to draw a line that connects the latest high points or low points of the RSI indicator. When the price breaks through this line, it tells us that the market is losing momentum. This gives traders a chance to find good trading opportunities with a good balance between risk and potential reward. Since the RSI measures how prices are changing, when the RSI changes direction and breaks above or below a trend line, it often leads to a big move in the price. To determine if the current trend is ending and a new trend is starting, we will use the RSI indicator. But we won't focus on whether it's overbought or oversold, or use it as a crossover system. Instead, we will go one step further and watch for a change in the trend's momentum. What I mean is, we will observe how the price changes compared to the highs and lows indicated by the RSI. By adding trend lines to this indicator, we can increase accuracy and find more potential trades. Since these signals are ahead of time rather than late, we can set our stop levels below or above the candle where the RSI broke its trend line. This allows us to take advantage of good trading opportunities with a balanced risk-to-reward ratio. Before entering a trade, we have one more requirement to consider. We want the price to stay above its trend line, and we also want the RSI trend line to be broken while the price is still trading above its trend line. This condition is crucial for the success of the RSI trendline strategy because it indicates a difference between how fast the price is changing and the actual price movement. Momentum is always ahead of price, and that's why this strategy can be very profitable. It helps us identify potential opportunities to earn good returns. When the RSI trendline breaks, it often happens before the trend line on the price chart breaks. This is like an early warning that a reversal is coming. Recognizing this break in the RSI trend line can be really important and profitable because it tells us that the price direction is about to change. It's like a signal that shows us what will happen before it actually happens. A leading signal is like a hint that shows up before a new trend or reversal happens. These signals are really helpful because they let you make predictions about what prices will do in the future, which can lead to profits. On the other hand, the RSI is a lagging indicator by nature. A lagging indicator gives a signal after the trend has already started. The downside of using a lagging indicator is that you might enter a position later than you should. You might be thinking, wow, if I use leading indicators, I'll become rich. It's true that with leading indicators, you can make profits right from the beginning of a new trend. However, leading indicators won't always be right every single time. So, even though you could catch the whole trend if the leading indicator is correct, it won't always be accurate. When you rely on leading indicators, you'll come across many false signals. Leading indicators are known for giving misleading signals that could trick you. That's why it's really important to closely observe the price action and not solely rely on indicators. Price action rules are designed to help us make money and become better traders. If you were to take a trade every time you see a breakout in the RSI trend line, you would soon realize that the results may not be as expected. Instead, we use the RSI trend line to support what we have already established with price action. So, it's important to analyze the price. You should identify key support and resistance levels, determine the main trend, and then look for RSI trendline breakout signals in the direction of that main trend. Here's a common mistake. Many traders who use the RSI trendline breakout approach treat it as a reversal signal, regardless of the current trend. For example, if they see an upward trend and a RSI trendline breakout, they may go short. While this approach can work sometimes, it's not the most consistent way to use it. Instead, we take a more conservative approach. When we identify an uptrend, we search for RSI trendline breakout signals that indicate buying opportunities. We have no interest in RSI signals suggesting short trades. We prefer to go with the main trend. Now, let's take a look at some examples. In this bullish chart, we noticed a few breaks in the RSI trendline. Using the trendline helped us visually confirm that there was a trade opportunity coming up. By using RSI trendline breaks, we received buy signals a few candles before the actual price movement occurred. In another chart, we can see an example of a short setup. The price was making lower highs and lower lows, indicating a downtrend. We added a trend line based on price action and identified the RSI trendline breakouts. When it comes to setting a stop-loss level, a common approach is to use the candle where the RSI broke its trend line. If you prefer a clearer view of the trend, you can add a long-term moving average to the chart and take trades in the direction that the moving average indicates. This can help you better visualize the trend. RSI, just like many other oscillators, is initially set to a default period of 14. This means the indicator looks back at the past 14 bars on the chart you're viewing to calculate its reading. However, the default setting may not be the best for your trading style. Short-term traders usually prefer a smaller period, like a 9-period RSI, to capture shorter-term market movements. On the other hand, longer-term traders might opt for a higher period, such as a 21-period RSI or even 50. Depending on your style, you can decrease the RSI period for more sensitivity or increase it for less sensitivity. Keep in mind that using lower RSI settings on shorter time frames can result in many false signals because the indicator becomes more sensitive. So, if you want to test this technique on smaller time frames, it might be better to increase the RSI value. For a smoother analysis with less noise, you can try using higher time frames. In this case, you can use a lower RSI period, which will offer more trendline opportunities. Alternatively, you can choose a higher period RSI, like 21 for example, for a less sensitive approach. The key here is to backtest different approaches and find the one that works best with your trading style. RSI is an indicator that follows the price movement. It's important to be patient and wait for a clear break of its trend line. Sometimes, it's a good idea to observe how the first candle behaves after the breakout before entering a trade. Remember, indicators are used to support what we already see in price action. In this video, I've included a template with the system that you can easily apply to your chart. It will automatically plot all the necessary indicators for you, so there's no need to worry. You can find the download link in the description. An important tip is to avoid chasing trades. When you chase a trade, you enter at a bad spot. Instead, let the trades come to you. To fully understand and maximize the potential of the RSI trendline breakout trading, I've included additional examples in the video.